Yes, sir.
Yes, we can see it.
Okay, good. Well, as Hutch said, I'm Mike Morawski, and thanks for having me on, Hutch and Heath. I appreciate you guys and the ability to come on and share my story that I think comes with a lot of success, loss, and redemption is how I would look at it. And I think I carry a message that, people need to be aware of, and some things that if you're not paying attention in business, that things can happen to you. So I want to make sure that and encourage everybody to get a journal, get something to write with, something to take some notes, because I will cover a ton of information. I'm going to talk about exit planning. I believe exit planning is one of the critical points of doing any type of real estate investing. Hey, whether you're investing in single family or whether you're investing in multifamily, it doesn't matter. But, as Hutch said, you need to have an exit plan to help keep your ass out of jail. And I told Hutch early on, I said, Hutch, I wasn't in jail, I was in prison. And I say that because with all sincerity, that's what happened. And as I go through my story, I think that we'll cover a lot of that. But I'm going to tell you how I built a multi-million-dollar company, how I lost it all, and how I wound up in federal prison as a result of it. I'm going to talk about how it all started first. I didn't come from a family that was entrepreneurial. I didn't come from a family that did real estate or thought real estate was a way to create wealth. But I figured that out as I got older. I remember the first time I was having a conversation with my dad. I was probably 8 years old. We were on family vacation, and I was sitting on the side of a swimming pool, and we were at a resort. And I asked my dad, I said, how come all the rooms and all the people? And I remember him trying to explain to me that people came there, they stayed there, and they paid the owner money for staying there. And at that point, I realized I wanted to be the owner. I wanted to be the guy that was collecting the money from the people living there. And, a couple decades later, I found myself owning, multifamily apartments and soaking it all in. I think my first exposure to real estate investing was in the early 80s. I went to a Robert Allen seminar. And if anybody knows Robert Allen or remembers him, he probably one of the oldest real estate trainers out there, but he was famous for no money down, or how they used to say, using other people's money, OPM. And what his claim to fame was that he would go into any city in the country, they could drop him off, give him $20, take his wallet, and by the end of the weekend, he'd own some real estate and have $100 in his pocket. He did it in St. Louis, and that weekend he bought 3 houses and had $4,000 in his pocket on Monday morning and slept in a fine hotel that night. When I heard that story and I went to that seminar, I was hooked. I've always felt success leaves clues, and people that were more successful than me had really set a way and a precedent to go and build a future. My career started out, I was in the construction business, and I had built a pretty large, successful residential construction firm. And one morning I woke up and I was just burned out. I couldn't do it anymore. I was still banging nails and didn't want to continue to go on. So I sold my company and I took a year off. During that year, I wanted to decide what I was going to do and how I was going to grow my business moving forward. Over that time, my wife and I at the time, we did a couple of house hacks. And that was long before house hacking was famous, right? Now today it's the sexy thing to do or the fun thing to do, and everybody's doing it. So we did a couple of 2 flats. And during that time, I met a real estate agent, and he was very successful in the real estate business. And like I said, success leaves clues. So I went to him and I said, hey, I think I want to become a realtor. And he said, I think you'd be good at it. I think you have the skills and the ability to sell real estate. I said, well, could I shadow you and you teach me? He said, no, I'm not going to let you do that. But what I will do is I will make you a cassette tape. Now I say that, I'm kind of dating myself, but I don't even know if there's anything to make a cassette tape on anymore. But he made a cassette tape for me, and I listened to that over and over and over again. Went in the real estate business. My first 8 months in the business, I sold 78 homes. I was Remax Rookie of the Year that year. I went on to build a team selling 125 homes a year. And if you know anything about residential real estate, the average agent in the country sells 12 to 15 homes a year. So I built a pretty productive team. In 2005, I saw that the market was starting to shift and change, and I knew that I would have to go do something else in order to keep up the same production or the same lifestyle that I had kind of grown accustomed to. So I decided to go in the apartment business. Now, I don't say that like I woke up one morning and decided to go in the apartment business. When I was
Hey,
in the
Mike,
yes,
we're still on the first slide, okay?
yeah,
We're only seeing the first slide, just making sure.
yep, that's where I'm
Okay.
at. Yep,
All right, good.
you're good, Hutch.
All right, thank you.
So, so 2005, I decided to go in the apartment business. And when I went into the apartment business, it was something I had thought about for years. When I was in the construction business, I did a lot of work for Inland. Inland is one of the largest REITs in the world. And a REIT is a real estate investment trust, similar to a mutual fund. Put money in, you're a little bit more liquid in that type of an investment. But here's what I like. 4 high school teachers went out, bought their first 4-unit apartment building in Chicago. And today they own assets in every asset class around the country, around the world. And they're one of the largest REITs. So what I learned from that was that there was the ability to successfully syndicate apartment deals. So in 2005, I went into the apartment business. I raised $18 million. I bought 4,000 apartments in 5 different states. It was about $60 million worth of assets, and went on to build a property management company managing 7,500 units. I did that in a 30-month period. And I tell you that because that's really how fast I grew and where I grew. You know, over the years, I've spent hundreds of thousands of dollars on coaching and training and books and tapes, seminars, and I've really gone and seen some really good trainers, some really good coaches, but I've always left feeling kind of empty. And I left feeling like I was missing something, right? But every time I left, I kept thinking there was something else. What I discovered over the years was that nobody ever taught me how to get out of a deal, that everybody taught me how to get into a deal. It taught me how to find a deal, how to buy a deal, how to operate a property, but nobody taught me how to get out or why to get out or when to get out. You know, actually, I just recently read a book, 370 pages. I'm sorry, 379 pages, and by a really famous author and trainer. And, you know, I got all the way to page 370, and in bold print, it says, "This brings us to exit plan." And there was about 8 lines, and it said, "After all your hard work, now you need to figure out how to exit the property." And I thought to myself, man, shouldn't we have thought about this before we ever got to the closing table? Shouldn't we have thought about what it means to exit a property, to get out of a deal before you ever get to that point? Because you really need to know. I always tell people, don't leave the closing table figuring out how you're going to run a deal now. You need to know that from the time that you go to contract or even before you go to contract in order to grow that deal. So there are struggles and challenges that we all face, you know, learning curves. How do we master things? You know, I always figure that education is really important. Not only does success leave clues, but you can go get your own clues, your own success by getting educated. I really feel that the more you educate yourself, the better strategies you can build, the better systems you can build. When you talk about strategies, you know, I bought that first real estate deal, that first apartment deal. It was 11 units. And I bought it not knowing anything. I took the seller's word. And I went into this deal, and the seller's telling me that you'll be able to raise the rent, you'll be able to do these renovations, you'll be able to re-tenant the property. And I believed him. And my broker told me the same thing. So I didn't do any due diligence. I didn't do any early evaluations of the property. I just went ahead and took everybody's word. And what I found out after I bought it was that it was all wrong. So here's what I did. Instead of getting frustrated about where I was at with this deal, We walked through it. We took care of all the problems that we needed to take care of, but it made me sit down with my broker. And I said, well, here's what we need to do is I need to figure out a buying strategy. I need to develop a strategy for what I want to buy. You know, I equate it today to like an avatar, right? You want to create that perfect avatar for the building that you want. So when you start to look at a buying strategy, we need to start looking at things like what the building looks like, what's visually appealing to you. I don't like flat roofs. I want a pitched roof. What type of siding, what type of brick, what type of staircase, interior entrances, exterior entrances, what's your unit mix? You know, you've got to have a growth mindset. It provides you the best method to win, right? Over the years, I've worked with a lot of investors and a lot of real estate owners. And, you know, I keep coming up with the same answers, or people will tell you things like, I don't have money to do this, or I can't think it through. When really, to invest in multifamily real estate, all you need to do is take what you're currently doing and make it a little bit different, scale it for yourself. And it always goes back to those buying strategies. It always goes back to the core basics, the core strategies of what you want to build in your business. You know, my goal is to help you overcome maybe some myths or some fears that you might have as a real estate investor or somebody that's trying to scale your business. Because when you have those strategies, see, it comes down to what purposes do you have? What is your day-to-day possibilities? How can you take a property? How can you scale it? How can you grow it? You know, the thing that I always like to teach is how do we create short-term cash flow and long-term wealth? And how do we do that in the property, in the assets that we're buying, that we're operating? You know, there's many different options. So I talk about the possibilities. You know, what are those possibilities? You know, we have to move through our fear. We have to move through the fear to get started and move beyond a lack of knowledge, because you have to increase your knowledge. You have to grasp your knowledge. And where do you go get that? You know, one thing I always ask people is how much do you put into your business every year for education for yourself? Whether you're reading books, whether you're going to a seminar, whether you're taking in information that's going to help you grow, to learn more, to do something different. You know, why do I say that exit planning is such a big deal? Well, because you have to have proven systems and proven models in order to get there. See, we all have to follow our dreams. You know, I think that if you give yourself reasons why you can do something versus reasons why you can't, and adopt that philosophy, it'll change your whole focus and it'll change the way that you do business and the things that you're doing. You know, I go back now and say, for years, I envisioned myself owning and operating apartment units, just like Inland Real Estate when I was following them and following their model. You know, today I call it, that's where the smart money is, right? That's where they're out building those types of businesses. And that's where I think ultimately you want to be as a real estate investor. Like I said, I didn't just wake up one morning and decide to go into that business. There's been different times in your life, I'm sure, that you've had a dream or tried to carry something out, and you kind of got stopped because you didn't have enough knowledge, or if you had the knowledge, you didn't have enough ability to execute and move forward. So I just want to encourage you to, you know, take in as much information as you can and be able to move forward. You know, Gary Keller wrote a book that I read that I think probably is one of the best real estate investing books out there. And in his book is this quote that financial wealth is the unearned income to finance your life mission without having to work. And I always tell people, you know what, focus on your goals, focus on your dreams, but have a really clear why, and really focus on what you're trying to accomplish and where you're trying to go. So let's look at some of the possibilities, right? In these possibilities, you really need to have some big goals. Are they measurable? But not only that, do you know why you want to have them? So, if I want to make $1 million, or you want to make $1 million, or you want to own 10,000 units or 500 units, why? Why is that important? Because I think that your why becomes your driving force. One thing about me is I ask a lot of questions. And I ask those questions because I want to know what all the differences are. See, I didn't ask enough questions before in my life. I built that company. I grew that company to 4,000 units. We managed 7,500 units, but I did it very unstably. So 2007, I closed 17 apartment deals for 2,700 units. I didn't take time to stabilize those deals in between. So I think that you have to have good models and good habits in place in order to help you scale a business, in helping you grow a business to get there. Those goals have to be measurable. There have to be targets set on them. Let's talk about systems for a minute. So, when I talk about a buying system, a couple other things within that buying system has to be what type of product. If you just look at real estate, right? You say, oh, I want to be a real estate investor. Well, what asset class? You could be in retail, you could be in office, you could be in 10 different asset classes. I always chose multifamily. But then if you look at multifamily, what asset class inside of multifamily? You have self-storage, you have tax credit deals, you have affordable housing, you have market rate rent, you have mobile homes. Where do you want to spend your time? I think that you could go and do a bunch in different asset classes, but I think if you really focus in on one asset class, you get really good. So now, if you focus in on market rate rents, workforce housing, is that an A class, B class deal? Do you know what those are? Do you need to get educated? So a question I always ask is, hey, what do you need to learn? What do you need to know? An A class deal, those are going to be your newer property, really upper end, built maybe within the last 12 years. Your B class deals might be products that were built from 1985 on. Your C class deals are going to be older than that. You have to look and see what the markets are. The market types are pretty congruent with the A, B, C, and D deals. So what markets do you want to be in? Where are you going to generate the cash flow? You see, because I believe that you can buy an A-class deal in an A-class market and make money, but you can also buy a C-class deal in a B market or a C market and still make money. One of the best deals I ever bought was in the middle of a farm field. Was all three bedroom, 64 unit apartment complex owned by the same owner for 37 years. He built the property. And here's what he did. He moved people in. People lived there for 20 years. They all were $200 to $250 below market rent. I was able to go into that property, re-engineer that property, increase the rents, do some upgrades, and that property threw off a couple of $100,000 in cash flow on an annual basis. That was just incredible. So that was, do the due diligence, do the research. Are you looking at the early evaluations on a property? Are you looking at the things that make sense and what you need to look at to be consistent? Know your fundamentals. I'm huge about fundamentals. Two fundamentals you really need to keep in mind. One is your exit plan. How are you going to get out? What makes sense about getting out? Stephen Covey wrote a book called 7 Habits of Highly Effective People. And chapter 2 in that book was called Start with the End in Mind. I read that book a number of years ago, and for some reason that chapter always stuck with me, right? And I said I went to all those seminars and all that training over the years. Well, it stuck with me, and I was like, well, why doesn't anybody teach these processes? See, because here's what I know. Exiting a property doesn't necessarily mean getting out. It just means getting your capital out, getting your principal out at a certain point, and re-engineering the deal again. And then the second key principle is make smart decisions. Sometimes even when we think we're making smart decisions, they might not be smart decisions. Our choices and decisions everything, whether they're good or they're bad, come with consequences. And you have to be willing to make those choices and decisions and render those consequences regardless of what they are. And there's things that can happen along the way that if you're not cautious about, can transpire. Um, like I said, I've worked with a number of investors and coaching clients over the years, and I really feel like I've discovered these five key metrics: that they desire to have greater financial security and independence, that they want to have more cash flow, that they want to get out of their job or leave the rat race, leave that W-2 job behind, that they want to spend more quality time with their family. And I've heard a lot of people say, hey, I want to spend more time with my family. But I think there's a big difference between family time and quality family time. And they want to have more control of their future. And I would ask you tonight, do you fit into any one of those categories? Maybe you fit into all of them and they all make sense. But you can take any limiting beliefs that you might have, you can take your old story and you can throw it right out, because there's new ways to do things, and you can take a look at new ways of growing your business. I also heard an investor say one time, I can't do this, it's way too complicated. That deal that investor didn't do, I went ahead and did the deal, and it was complicated, but boy, did we learn a lot along the way, and we grew as a result of it. So creating those strategies, creating those systems help you overcome any limiting beliefs or roadblocks, those stumbling blocks that hold us back. Because I think a lot of times we're held back by roadblocks and stumbling blocks. I don't know anybody that's gotten in the apartment business that hasn't had to have some growing pains along the way, that hasn't had to learn some things. It's just like, when you go and underwrite that first deal, what is that like? I'm working with a coaching client right now, and we have been working on underwriting the last few weeks. And we take a robust Excel spreadsheet, and I have this system that I have built over the last several years that we plug these metrics into, and invariably it tells us whether or not this deal is worth buying. And the math doesn't lie. When you put the income in and you put the expenses in, and you run the trends over 10 years with increase in expenses, increase in rents, with CapEx dollars going in, you're going to get an answer. You might not like the answer, and you might have to underwrite a number of deals in order to get there. But underwriting is just one of the fundamentals. Along the way, while you're doing that underwriting, you might want to be doing some planning. So if I put X amount of dollars into the interior on this property, if I put X amount of dollars into the exterior on this property, what does that do to my CapEx? What's my return on my renovation? All things that you want to look at. So do you have tools that are going to help you do that? Like them or love them, Steve Jobs has been one of the guys that I have a lot of respect for over the years. But when he returned to Apple, upon him coming back to Apple a number of years ago, before Apple's big turnaround, he said he was going to come back and put some fundamentals in place that were going to just push the human race forward. And I always liked that, because he was going to make some strategies. He was going to do some things differently. One of the first things that he did was, when he went into Apple, was Apple had like 5,000 products at that time that they were trying to sell. And he whittled it down to about 250 products. So he threw everything out just to rebuild that company. And I look at it like, when you take over an apartment complex, you're taking over a business. So whether you're taking over 2 units, 4 units, or 400 units, you're taking over a business. What can you do to re-engineer that? So no matter the type, no matter the size of the property, the metrics are the same. The same techniques are in place, or you need to have in place. So a lot of the insider secrets create endless opportunities to create that short-term cash flow and long-term wealth. So when I start talking about exit planning, I don't talk about just selling a property and getting out. You know, a lot of people say, well, you know, if I'm going to exit a property, I'm just going to pull my capital out. Well, that's not necessarily true. I think there's a lot of different ways that you can re-engineer a property. You can liquidate it, of course, and pull all your capital out. But when you do that, you give up complete control. You lose any asset value, you lose any cash flow. I think that there's other ways that you can go about it. One could be that you recapitalize the property. If you recapitalize the property, now you can pull capital out. Here's what I want you to think about. If you do an evaluation on a multifamily deal, you buy it today, and you're going to do a 10-year spread or a 10-year evaluation on that, or you should be when you're doing your due diligence or your underwriting. And if you look at that, somewhere along the line, I would challenge you to look that there's a sweet spot. Somewhere between 5.5 and 8 years is going to be your highest profit potential. And the reason for that is you've done all your capital X improvements, you've re-tenanted the property, you've got it to a point of stabilization where now you're at that point where it's most profitable. Now what happens is it starts to balance out or taper off, and your income will come down a little bit. And it's not a lot. It could be, 100 basis points, but it still tends to come down. And when it does that, at that high point, why don't you refinance it? Why don't you pull that capital out, that profitability out at that point, and then re-engineer the deal for another 10-year spread? You don't have to keep it that long, but run it for another period of time before you get out. But do something at that point. Another, because what you're doing is you're maximizing that profit potential. Another way is you could bring a partner in. And I always like this opportunity. I bought a deal one time in Texas, in Dallas. It was 187 units. And it was 87 townhouses and 100 apartment units. And I was getting ready to try and do my first multifamily, or I'm sorry, institutional deal. I was trying to close this deal with an insurance company. I wined and dined this insurance company, and we were getting pretty close to closing, and they decided they didn't want to do the deal with us. And I was kind of lost. I didn't know. I was like, wow, I can't believe that, we've jumped through a bunch of hoops over the last 4.5, 5 months with these guys, and now all of a sudden they don't want to do the deal. Well, what I discovered was they just weren't sure about us yet. They just weren't sure of my track record. And at this point, I owned about 2,800 units in 4 different states. What we did was I closed that deal with some private investors. I brought in 9 private investors. We closed the deal. The insurance company was actually kind of surprised. So this was a life insurance company out of Omaha. And for the next 8 months, he kept calling me and finding out how it was, what we were doing. Every 60 days or so, he'd ask me to send him a report, and I sent him a report. Well, one day he calls me and says, hey, could you meet me at the property? I said, really? You want me to? He goes, yeah, I want you to meet me at the property. I like what you've been doing. I want to talk to you. And I really didn't know. He said, come on, we'll go golfing. And, I kind of built a good relationship over this period of time with this CIO, the chief investment officer. And we meet at the property. He says he wants to recapitalize the deal and come in as our partner. I was about 50% with the 50% done with the turnaround at that point. We re-engineered the property 50%. He really liked the way the numbers were headed, where the property was going growth-wise, what we had done, curb appeal, and the appearance on the property. So we wound up taking out our private investors, bringing in this equity partner, and we actually pulled a couple $1 million of profit off the table at that point. So I tell you, look at all your options. Now, that happened to be an exit plan that I didn't know about early on, but I did discover over a period of time where it was profitable and how that could become another option. So I tell you, just weigh your options, look at different things, look at different scenarios. But when you sit down and you start to look at your income statements, your expense ratios, and you look at those and say, okay, this is what I know I can do. I can drive the rent this much. If I put this much CapEx money into the property and I put new cabinets in, new countertops, maybe some new bathrooms, maybe upgrades in the hallways, maybe some curb appeal. Now I can bring in a different tenant base. Now I can raise my rents. One thing I want you to watch though, if you think you're going to raise your rents $100 or $150, do you know that the household income in the area will substantiate those rents and those increase in rents? So these are all things that you need to be thinking about prior to and after. There's a lot of ways that you can reduce expenses. So I always say that the perfect storm is when you can increase income and decrease your expenses. You've really changed the NOI of that property. This all it becomes based on your purchase criteria. What is that criteria? What are you buying? Because if you can start to close off the small leaks in the balance sheet and increase that profitability, you can change those dynamics, those metrics very drastically. So they're all things that you need to look at. There's a lot of assumptions to look at as you are starting to, sit down and underwrite a deal, right? So when I work on my exit plan, I want to look at all these things up front. So by the time I go to contract, I want to know that I can increase my bottom line, my effective gross income, that I'm going to be able to increase that by increasing my rent. So how much CapEx do I need to put in? How can I decrease my vacancy? How can I decrease my loss to lease? How can I increase my other income? I'm a really creative, out of the box thinker, and I love to take a property and increase other income. How can I do that? By creating some parking spots or creating a garbage valet service, or can I put in a business center that can produce a little bit of revenue? How do I increase revenue? How about a utility program that bills back the tenants for the utility service that you pay for as an owner, and now you can collect on a portion of that rent back? So there's a lot of different ways to look at increasing income on a property. Like I said, be creative, think outside the box. I think a lot of times we work inside these boxes and we find that we miss opportunities. And that happens, I think, a lot along the way. But the other thing I say is don't go in and increase all the repairs. Don't go in and increase all the rents. Don't do everything on a property, because really what you want to do is you want to leave, like I call it, some meat on the bone for the next buyer. If that buyer is coming in and they're looking for opportunity to re-engineer the property and you've made a decent amount of profit, this goes back, I'm a win-win guy. I want to continually create win-win situations. I can put a higher standard in place. I can do a lot of things, but I also want to make sure that I'm leaving something for the next buyer for a couple of reasons. The big one being that the property will trade faster if there's opportunity for the guy behind me to make a profit as well. So, I don't need to be greedy anymore. Any disruption in any of the current owner's systems, income, expenses, status quo procedures create more profitability. Remember, this is all about creating more cash flow and long-term wealth. So if I can increase that cash flow today and increase long-term wealth tomorrow, then I make my investors happy and I'm happier along the way. I want to just give you guys a couple of things to think about on how we can decrease some expenses. You might want to write some of this down, but can you go in, and one of the big things, expenses in an apartment, is the water usage, the owner's water usage. I always find leaky toilets, leaky faucets. And if you can go in and rebuild toilets, you can buy a system to rebuild the guts on a toilet for $3.99 if you buy them in bulk. And you can go in and start to rebuild those. I've always found that that's been the easiest way to reduce some expenses right away. How about inoperable electric outlets or switches that might be drawing juice? Can you put any automatic shutoffs in hallways, in laundry rooms? Can you put water consumption valves on your washers and have the water shut off a little bit sooner? How about in showers? Can we put different shower heads in that conserve water? So where are you losing dollars on a particular property, even on something you own today? Where can you go in and cut back on that? So those are the things that help. Even when you have boilers and furnaces that aren't efficient, that's places that you can start to make those changes and see different results. One of the things you want to look for up front is the traps. And this really equates to exit planning, because if these traps don't measure out for me, I'm not even going to get to the stage of a buying criteria or underwriting a deal. But the household income, most of the time you want to see that the household income is 3 times the rent, right? So if somebody makes $1,000, if somebody's rent is $1,000, you want to see that they're making $3,000 a month, or on average, right? You want to make sure the schools measure out. What are your criterias for schools? How about crime rate? I bought a property one time that I didn't realize how bad the crime rate was, but the police were at the property 28 times a month for domestic disturbances. You know, I don't think any of us really need those types of headaches in our life, but it happens. So is it palatable? Is it something you can turn around, or is it not worth it? How about the demographics? Do the demographics measure up for the schools, for the crime rate? Are you going to be able to re-engineer the property based on the demographics? I don't know. Those are questions you have to ask about the property and about the market, and everyone is going to be different. Job growth, population growth. One thing I always say about those is people say, oh, they've been flat for the last 10 years. Well, I don't believe they're flat. I think they're moving backwards, or just on the verge of slipping backwards. So if we're not moving forward, we're typically moving backwards. I think it's the same thing with our education, right? It's the same thing with our growth, that if we're not moving forward, if not, we're not gaining, that we're moving back. And rent growth. Is the area conducive for rent growth? If you're going in to plan to raise the rent $100 or $150 a month after you put CapEx in and re-engineer them, are you doing it? Are you going to be able to do it? So these are things you need to look at. In my story, I tell you that I built this company, right? I built this company I scaled it to 4,000 units. We were managing 7,500 units. I was in 5 states. I owned $60 million worth of real estate. And I was over leveraged. So one of the mistakes that I made was I was over leveraged in the property purchases. So I bought at too high of a price, and then the banks were allowing us to buy property at 10 and 15% down. So when I talk about being over leveraged, my average loan to value on $60 million portfolio was 85%. I would never suggest to anybody to be in a deal today at 15% equity or 85% loan to value. You should be in 65 to 70%. Make sure you're not overpaying for a property. I think one of the things that happens to us is we fall in love, we get really excited about a deal, and we kind of don't pay attention to some of the red flags. I didn't pay attention to a lot of the red flags that were happening around me. There were metrics that weren't being paid attention to. Uh, I thought people were taking care of stabilization. We weren't stabilizing property. Like I said, I closed 17 properties in 2007. It was like balancing a chair on 2 legs, trying to lift my feet off the ground. Very unstable. So when 2008 came around and the market hit a wall and we crashed, it was like a freight train at 200 miles an hour. All of a sudden, occupancies changed, NOI dropped. I couldn't pay my bills anymore. I found myself scrambling, wondering what I was going to do. in order to keep my investors happy and keep my properties afloat. So I started having some properties start to go to foreclosure. Some investors that I knew were going to get hurt. I'm the kind of guy, I'm a hero, and I like to not let anybody get hurt. I like to not see any types of situations or problems happen. So what I started to do was I started to move money between companies. I had 38 different companies. So I figured this company's operating well, this company's faltering. Let me take good profit from this company. I'll move it over here. Now, mind you, my attorney and my accountant said that that's okay. Leave a note. It'll be fine. When the market changes, you put the money back. Great, great plan, right? From a 10,000-foot view. What happened was that I had seen corrections in the marketplace over the years, and the markets had crashed, had only corrected maybe 10%, and it bounced back in 17 or 18 months. But what had happened here over the years, or in 2008, was that the market changed 40%. And it took maybe 7 or 8 years for that market to bounce back. Well, as a result of that, I moved money. I was never had the chance to put money back. That wasn't the problem. The problem was that I didn't disclose to my investors what I was doing. And as a result of that, I wound up being charged with wire fraud and mail fraud charges and sentenced to 10 years in federal prison. And it was all because of some silly business mistakes and not paying attention to the things around me. And I had plenty of people in my corner telling me, hey, don't do this. What are you doing? Pay attention. But I didn't listen because I thought that I could outsmart the market, and I couldn't. So I tell you this because I want you to pay attention to the things around you and the things that could make a difference in your life if you're not cautious or not careful in what you do. Ultimately, I went to prison, and I thought my life was over at that point, right? That was the worst it could ever get. Well, when I went to prison, then my wife decided to divorce me. And that's when I really had gotten to the bottom of the bottom and decided, didn't really know what I was going to do. Well, there's a saying in prison that says that you can either do the time or let the time do you. And I was probably gone for about 6 weeks, and I was really, I was a mess. And this guy walked up to me in the gym one day. I stuck my head in the gym to, kind of had that thought, well, maybe I'll start working out. And he said, look, don't let these people beat you. He said, all they want to do is take everything from you. They've already taken your business. They've already taken your family. They've already taken your life. But don't let them take what really matters. And that's your smarts and what took you to that place and your ability to do that. And for whatever reason, that conversation really resonated with me. It really made sense. So at that point, what I decided to do was start working out. I decided to do the time, not let the time do me. I went to school. I got a bachelor's degree in theology. I wrote 2 books. One is called Exit Plan, Your Complete Guide to Multifamily Investing and Why You Need an Exit Plan Before You Buy. I wrote a book on property management. I wrote an ethics course. How ironic, right? Somebody in prison teaching ethics. I taught real estate. I taught ethics. I taught Bible study for 5 years. I was on an outreach program. I went into the community and told my story to the local business owners and local area college students for 5 years. I did that and wrote a paper with a professor from the University of Minnesota that we just had published in the Business Journal of Ethics that gets taught at the college level. Now, I tell you this not to impress you, but to impress upon you that there's redemption, that there's hope, right? So I built a couple of really successful companies over the years, and I lost it all. I lost it all because I didn't pay attention to the metrics. I didn't pay attention to what was important to the planning, and wound up finding myself in a position where I I didn't find myself, or I found myself in a position where I didn't pay attention to all those metrics that really make sense. So today I, have this opportunity to re-engineer myself, and I'm in the coaching and the training space. I wrote this book. You can write this down. You can go download an ebook or a free copy at my website, which is mycoreintentions.com/exit plan. And you can download a copy there. But my message today is that I want people to understand, I don't care if you're a man, a woman, if you're in a C-suite, if you're building a business, running a team, middle management, that everybody can make mistakes. We get hung up on the things that we don't pay attention to. Make sure that you're thinking things through, and make sure that you have people around you, you have a team around you that is paying attention to you, what you're doing, and that you have people that you can go to ask for help, ask for guidance. I know we've gotten really late here on time, and I'm just trying to kind of speed up, but I want to, put it back to you, Hutch and Heath, and if you guys want to ask questions or whatever, but I appreciate the time, and I know I kind of rambled a little bit here tonight, but.
No, Mike, this has been amazing. This has been really great stuff. So, I think one thing, so it's a tale of caution. How do you navigate situations where the team that you put together is giving you advice that turns out to not be the advice you needed, or even legal? I meant you go to these people because they have some sort of authority on the issue. And so what advice would you give to someone as they're trying to sort out who they should turn to for such advice?
Yeah, one of the things that I teach early on when I work with coaching clients, and that is I teach building a team. Teamwork and networking is really important. Who you have around you, who you surround yourself with. And I had a board of advisors. I had 12 men and women that were a lot smarter than me. 8 of them were not even in the real estate space. They were entrepreneurs in other industries. And these were guys that and gals that helped me build this business. I went to them and they helped me raise money. They brought deals to the table, and they brought expertise and knowledge to the table. Well, in 2010, I was walking into a board meeting one night, and I was planning to talk to them about what was going on and where we were at business wise. And I was met in the parking lot by my in-house legal counsel. Now, mind you, this is somebody I pay a couple $100,000 a year to, who, I thought had my back, had my best interest. And here's what he said to me: don't talk to the board tonight about what's going on. We don't have enough information. And I was like, wait a minute. I said, we're coming to this meeting tonight to talk about this because I think that we need this help. We need the direction and the guidance. He said, no, we don't have enough information. He said, give me 2 weeks. In 2 weeks, we'll put together a call, and we'll get everybody on a call. We'll lay out a plan, and we'll get their opinion at that point. So against my better judgment, and this was like the third time that I didn't follow my real instincts. I followed somebody else thinking, this guy had my back. I didn't talk to my board that night. And Hutch, I think it's really important, or Heath, I think it's really important that you follow not only your gut, but your head. You build a company to a certain point because of what you know and what you've learned along the way. And now what you need to do is you need to continue to do that, even in the face of adversity. And I think that that's what I didn't do that night. There were other times that, my outside legal counsel told me that he didn't trust my in-house legal, and he didn't trust my partner. And I'm not saying that to throw anybody under the bus. And trust me, I'm not saying that I didn't break the law, because I did break the law. I didn't disclose to my investors what I was doing, or what the results could have been. But I didn't pay attention to those red flags, to those metrics. And so often we do that. And I just want to, just kind of advise people, hey, pay attention to what's going on around you.
Oh man. And then the other question that I've always asked, especially whenever I first started getting into multifamily, was I was always curious and like, who buys these properties after you do all the rehab and everything to them? And people are always like, oh, you just got to leave some meat on the bone. If you leave some meat on the bone, you'll be able to sell it. And there'll be people who buy it, because it seems like once you maximize profitability, it'd be difficult to find someone who would want it unless you're in like some super crazy primary market. So you had some listed on your slides, but what's some of your top strategies for making the property still enticing for the next buyer?
So I think you asked a couple questions there. Let me answer the first one. Who buys this property after you're done with it? I think somebody just like you or me, Heath, right? You or I bought it from somebody just like you or me is going to go buy it. And, or an institutional buyer, or somebody, who has a hedge fund or a endowment, right? There's a lot of buyers out there. And today there's more buyers than there ever was when I was syndicating deals. So anybody that's out there looking for multifamily today knows what the competition's like. I think that, what was the second part of that? What else can you do to a property? What do
Right. So, like you want to leave some meat on the bone. So like, do you only do say 80% of the upgrades, or do you hold off on the rubs and that for the next buyer? What would be some of the strategies which you want to, because you want to increase cash flow now and force appreciation, but then there's got to be some delicate balance between adding as much as you can for you and your investors, but then where do you draw the line, or what's going to be something that's still enticing sort of after you're done with your business plan?
So great question. So like if I look at the rents and I say, okay, I'm going to go in and I can put new floor coverings, lighting, bathroom fixtures, some new kitchen fixtures, some paint. And then I know I can push the rents, maybe call it $100 a month, right? Just for basic math. Maybe I don't push the rents that much. And maybe instead of doing $2,500 in an upgrade in a unit, I only do $2,000. That leaves still the ability for the new guy, for you behind me, to come in and put a lighting package in, or to change out kitchen countertops, or to change out bathroom fixtures, whatever that may be that I left off. And I don't tell you that because you have your own vision, right? You have your own buying criteria that you're going to look at. But there are those things that, instead of raising the rent $100, maybe I only raise it $80, because now I still leave that room in that NOI. I don't need to be greedy. Maybe when I do my pro forma, instead of putting in 3% per year, or organic rent growth, maybe I only put in 2.5%, and back that off a little bit, and I stay within those metrics. So when I run a stress test on my underwriting, can I find those metrics or those places that make sense to not really go overboard or do too much? So here, I looked at a property one time, and it was owned by a nonprofit. And I had to really love these guys, because they fly in their private jet. I meet them in Dallas. This is a 287 unit deal. And I built a relationship with these guys over time. And finally I asked them, I said, you guys have 3 private jets. What's the deal? They said, man, we make so much money as a nonprofit. We have to spend our money somewhere. And that was one of those things where the light bulb went on for me. And I went, man, there's so much money in this multifamily business, right? And there's a lot of money for everybody. So here's what these guys did. 287 units. When I pulled up to the complex, the water feature in front was all overgrown. The gate was rusted about 3/4 of the way open. The fence needed to be painted or rebuilt. The flags were tattered. The flagpole looked like a strong wind would knock it over. There were 74 units that were out of commission. 54 of those 74 were totally unlivable. They had stripped all the fixtures, doors, hardware out of those 54 to keep the rest of the units operating. The rents were all about $100 below value. So I knew that I could go in and just by putting those 74 units back in service, that I could increase the value of the property $1.4 million, because I could increase the cash flow $1 million, but it was going to take me $850 in order to do that. So I kind of knew those metrics walking in. And that was just to get it right. So there was still a rent push to be able to do. I money on the table for the next buyer. So these are all things I think you start to look at. You start to see in your underwriting, you get to a point where you can run some numbers on the back of a cocktail napkin as you look at a deal, and you can say, this might work or it might not work, right? I penciled the deal today and I looked at it and I said, wow, this is a 10% cash on cash return. And I forgot one metric. And as soon as I put that in, it took my 10% down to 3. And all of a sudden the deal didn't work anymore, right? So,
Yeah.
and it was a CapEx thing, right? I needed to add more money for some interior upgrades on 140 units, and it just totally changed the dynamics. So it's amazing when you start to look at these things, what you find.
Does an exit plan change when it comes to, say, reposition, taking something from a C to a B?
Yeah, I think your exit plan, I don't think you should ever be set firm on anything. I think a lot of things change along the way. I think you can go in with an exit plan, and all of a sudden, like I did on that one deal, decide to bring a new partner in. Now we redesigned the exit plan, and we knew 7 years later we were going to get out of that deal again. So there's different ways and different things you need to look at along the way.
Oh man, Hutch, what do you think?
Yeah. Are there any questions? There's no questions in the chat box. I think Candace was the one that asked the last one.
Yeah, how would you recommend finding a good team? How would you recommend vetting them?
I think you asked that question, right?
Yeah, to some extent.
Yeah, I think it's just interviewing, meeting people, talking to people. I think there's a comfortability and a track record you look at. So, hey, if you're a passive investor and you're vetting a sponsor and you're doing passive investing, even if a sponsor doesn't have a track record, you might feel comfortable with them and believe in them, and that's okay. And you might do really well. You could go in with a sponsor that's had experience in the market change and not do so well. Investing is inherently risky, right? I mean, any offering you look at, you need to look at that language in the first 2 pages because it's buyer beware. So I think you just need to look at that and, yeah, it's using common sense, but it's also using your gut. I always use my gut, even with a tenant for the last decision.
Alrighty. Yeah, great information. I think Glenn got a question. Let's see. So there's a question here. On the road to recovery, right? How is it when communicating with financial institution as far as you purchasing more projects?
That's a great question. I haven't purchased anything yet. I know that I've talked to a number of financial institutions, and some say they won't touch a felon, and some say that they will. So until I go back and actually do a deal, we're not gonna, I don't know for sure, so I don't have a good answer around that. I just know what people have said. Now, what I will say is that I think, again, you bring partners in, right? Hey, if you're a new syndicator, if you're a new operator, you're gonna bring somebody in with experience. You're gonna bring a key principal in. You're gonna bring your private equity people in. This is a team effort. This isn't a solo deal. And there's so many people in the space today. You have a lot of resources. So
Yeah, got you. So I know a lot of folks are concerned whenever raising capital because especially they want to make syndication their business, right? They want to dot all their I's and cross all their T's to ensure they maintain good faith with the Security and Exchange Commission. What power do they have over real estate syndicators?
um, well, one thing in your PPM, if you should make sure that if you're a passive investor or a limited partner, that PPM states that if the operator is not operating that property to the fullest, or to, that the limited partners can take over the management. So I think that that's a pretty standard uptick in a PPM, and that, people need to look at that and make sure that that's there. When we talk about PPMs, I know that in my documents, I always had that. And, and I went to my investors a couple times and they were like, no, we're not, you're doing a fine job. Well, we really weren't. Um, uh, and the other thing is that I did in my documents, and this was another mistake, right? If I had to say, this is one of my top 10 mistakes that I made, was that I had in my documents that I could not go back to my investors for a capital call. So if we needed cash in a deal, I had took that out of my PPMs. Listen, the market in 2007, 6, 5 was so hot, and that, you know what, I was blinded to the fact of the growth, that I didn't think that things were going to crash. I remember sitting at lunch in 2008 with my CFO, and the TV's on. We're watching the news, and they're carrying boxes out of Lehman Brothers by the dozens. And I looked at him across the table and I said, "We're in big trouble, aren't we?" He goes, "Yeah, we're in big trouble." And Lehman Brothers went down, Bears and Stearns, AIG, the world, turned upside down. So um, would any of that happen? Hey, if there was a 10% correction, um, none of that would have happened. If there was no correction, none of that would have happened. But, because of what happened, I made some other choices that caused the default.